Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Every month we look at the latest economic data to see if they can tell us about the current state of real estate markets and where they might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. Today, I want to look a bit more closely at something we mentioned last month, the slow rate of population growth. In 2021, the US population grew just 0.1%, basically not at all. You might say, oh, well, it's the COVID pandemic, there were 1 million deaths, and that's partly true, but note that the decline in growth was already happening before 2021. And going back before 2010, which is not on the chart, the average rate was normally around 1% and sometimes quite a lot more. Right now in 2022, it's growing at about 0.3%. And my guess is that it will climb a little bit, but not much more. Why does any of this matter? Because the US economy and US businesses are built around the idea of constant growth. If the population isn't growing, where will that growth come from? Some other countries have solved the growth problem through exports. The German population hasn't grown in the last decade, but the German economy has. Its exports are as big as those of the US, a country 4 times as large. I don't know if that can happen here, but if it does, it won't happen anytime soon. A slowing population means low job growth, which means a slower real estate market, less internal migration, and an ever larger percent of people who can't afford to buy a home. In the middle of the current real estate boom, this may seem like an unlikely problem to worry about. There's been more demand than supply, not less. But investors, as well as builders and lenders, should start thinking about how housing and real estate will be different in a low growth economy. In the meantime, short-term growth has been pretty good, with jobs overall increasing almost 3% since October of last year, as shown by the red bars. It's true that compared to the level just before the pandemic, jobs have not quite recovered, as you see here. So in a way, we're still comparing apples with oranges, new jobs compared to recovered jobs. But the short-term trend, at least, is encouraging. The manufacturing sector, even though a smaller slice of the economy than 20 years ago, is one of the bright spots in the job situation. In construction, the picture is much the same, as higher home prices have spurred home construction. And once the infrastructure spending bill kicks in over the next few years, job growth in this sector should be even better. In the finance sector, growth is more modest, but jobs in finance produce homeowners. The recent job gains in the retail sector are a bit of a surprise, since retail jobs were flat even before COVID hit. Maybe it's a burst of optimism from small businesses. Business services already recovered the lost pandemic jobs before the end of 2021. It's on pace to grow 4% or more this year, a very positive sign. On the other hand, business service jobs are very vulnerable to a new recession. In healthcare, many of the lost pandemic jobs remain lost, despite recent hiring. And the same is true at restaurants, despite a 5% gain since October. In government, a very large sector, almost none of the lost jobs have come back. So some sectors are growing well, others are not. The economy is still dislocated. After previous recessions, recovery was often rapid because of strong population growth, sometimes fueled by immigration. This time the growth is slower and the economy more vulnerable. This is probably the new normal. That's it. In this time of uncertainty, let me plug our Investors Metro analysis, which forecasts home prices and rents, calculates investment risk, and provides strategic analysis for every local zip code. It's available for 200 markets. It's written for investors, not academics. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.